Where are mortgage rates headed in 2024? The question that every person wants to know. Is there a chance that we could see mortgage rates back down in the 4% range? Or is it possible that we see mortgage rates move above the 8% level that we saw this past year? Well, that's exactly what we're going to dive into in today's video. I'm going to give you my 2024 mortgage rate forecast. Now, why should you pay attention to this? I've been wrong in the past. Well, just like anything else, I base it off what's happening in the economy right now, what's likely to happen in the economy, as well as me following other really smart people out there to give you my predictions on what's likely to happen moving forward. But with that, in order to understand where mortgage rates are going or headed, you need to understand what's actually impacting mortgage rates at the moment. And that's exactly what we're going to dive into in today's video. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up, and also subscribe to the channel to stay updated on everything mortgage rate, housing price, and real estate related. As you're probably aware, mortgage rates are influenced by a number of different factors. But one of the main reasons that we've seen mortgage rates move up so much over the last 2 years is because of the Fed. The Fed started hiking the Fed funds rate, going from 0% upwards of 5.5%. And during that period of time, we saw mortgage rates go from the mid 2% range as high as 8%. Now, the Fed hikes weren't the only reason that mortgage rates went higher. We also had the spread between the 10-year and the 30-year widen, which also allowed mortgage rates to go higher than previously thought, in addition to the 10-year Treasury hitting a 5% intraday high. And with all of those different things, we saw mortgage rates peak above 8%, which was a 23-year high. So the question is, why did the Fed start hiking rates to begin with? Well, the Fed has a dual mandate. One is price stability to control inflation, and the other is full employment. And because of all of this extra money, this extra savings, and people being stuck at home, we saw consumers spending a lot of money, in turn pushing the price of goods higher, which ultimately caused headline inflation to hit 9.1%, which is significantly higher than the Fed's 2% target. And with this, the Fed started to aggressively hike the Fed funds rate, going all the way from 0% to 5.5%. And with that, we've seen inflation come down to 3.1%. Now, something to note, the Fed's monetary policy right now is still very, very restrictive, because we have inflation at 3.1% and you have the Fed funds rate currently sitting at 5.5%. But here's the good news. As of right now, the Fed is predicted to lower the Fed funds rate somewhere between 3 and 6 times in 2024, which means if they lower it by 25 basis points each time, then the Fed funds rate is likely to drop anywhere between 0.75% upwards of 1.5%, which means if they went the latter route, the Fed funds rate would be sitting at a target of 4%. But if you remember just a moment ago, I said inflation was at 3.1%. So even if the Fed does cut 6 different times and takes the Fed funds rate to 4%, you still have super restrictive policy. And on top of that, something else that you need to factor in is that inflation is continuing to decline. In order to calculate the inflation numbers, what they do is they take the month-over-month numbers and add them together, and that's where you get the yearly inflation numbers. And as of today, we're sitting at 3.1% headline inflation. But if you take a look at this chart here, you got a 0.5 in January, a 0.4 in February, and another 0.4 in April, which equates to 1.3% of the total 3.1% inflation. And what's going to happen here over the next couple of months is we're going to see that 0.5 fall off, and it's likely going to be replaced with a 0.1. And then in February, we're going to have that 0.4 fall off, and it's likely going to be replaced with a 0.1. And then in April, you're going to have that 0.4 fall off, and it's likely to be replaced with a 0.1. So you're going to lose 1.3%, you're going to gain 0.3%, so inflation is going to drop by 1%, taking it from 3.1% to a likely number of around 2.1% at the end of April. And the reason this is important is because that gets us really, really close to the Fed's 2% inflation target. But here's the thing, if inflation is sitting at 2.1% and the Fed lowers us to a 4% Fed funds rate, we're still extremely restrictive when it comes to monetary policy, which means there's a very high likelihood that the Fed is going to lean more towards the 6 rate cuts than they are the 3 rate cuts, because I do believe the Fed is trying really, really hard not to have that hard landing in the economy. They want that soft landing in the economy. And at the moment, employment has remained strong, which is another piece of the Fed's mandate. And as employment has remained strong and inflation has come down, that's given the Fed essentially the green light to start to talk about rate cuts. But here's what you need to know. The Fed isn't going to come out and say we're going to cut 3 times for sure, 4 times for sure, 6 times, or whatever the number is, because they don't want to front run those rate cuts. Because if they do, that would cause borrowing to start picking up, people to start spending money, and in turn could drive inflation higher. And that's exactly what the Fed is trying to avoid. So the Fed is going to take it step by step. They're going to be data dependent, but the likelihood of the data continuing to soften is very, very high, which in turn is likely to lead to lower mortgage rates. So the question that everyone wants to know is, how low can mortgage rates actually go? And that's a very, very difficult question to answer, because it has everything to do with the direction of the economy. If the economy comes out really, really strong in 2024, employment numbers continue to improve, unemployment continues to go down, in addition to having strong GDP, consumer confidence, PPI numbers just across the board of durable goods. If everything is really, really strong out there, then chances are rates won't move quite as much as what we've seen over the last 2 months, when we've seen rates go from 8% to 6.5%, that 1.5% drop. So if the economy stays strong, there's a really high likelihood that you're not going to see another 1.5% drop in rates. In fact, in order to see a meaningful move, a more meaningful move in mortgage rates, interest rates in the mid 5% range, low 5% range, you actually need worse news in the economy. You need employment to get worse. You need unemployment to go higher. You need consumer confidence to come in lower. You need manufacturing numbers, PPI numbers, all of that to come in lower than expected, which shows that the economy is softening more than originally thought. And the idea that a hard landing is more in the cards than a soft landing, because if a hard landing is coming for the economy, that means more bad news for the economy. And the more bad news you have in the economy, in theory, the lower rates can actually move. And so at the moment, I'm under the camp that there's a chance for a soft landing in 2024. I do believe that there's an opportunity for employment to remain somewhat strong, for the overall economy to remain somewhat strong, at least for the better part of 2024. Now, things can change, things can get worse, things can get better, but I do believe there's a high likelihood that if the Fed does continue to pivot, if they do continue to back off the Fed funds rate like we think they're going to do, that there is that opportunity for a soft landing, which in turn means that mortgage rates are likely going to end up somewhere in the mid to high 5% range. But with that, you're likely to see some volatility in that market. You're likely to see some reports come out better than expected, and then you're likely to see some reports come out worse than expected, which means just because you see rates move down 1 week doesn't necessarily mean that's the trend forever. You're likely to see them move down and then them back up and then bounce around because of that volatility out there in the market. So the question that a lot of people ask is, are we going to see 4% rates again? And I think the answer is yes, you're going to see rates in the 4% range again, but I just don't see it happening in 2024 without worse than expected economic news. But here's the thing, somebody that I respect greatly, somebody that we recently had on the Educated Homebuyer podcast, which I'll link to a video here where we interviewed him, Matt Graham, was on CNBC last week and actually discussed the idea of mortgage rates hitting the high 4s in 2024 and exactly what needs to happen in order for that to take place. In fact, here's a clip of that video right now.
What would you expect the rate to be into next year based on what the Fed said yesterday?
Oh, yeah, that's good. Get me with the predictions, right? I love those. So, look, the rate momentum is as good as the trajectory of economic data. So if the data continues to do what it has been doing, there's no reason rates couldn't go down into the 5s, possibly even high 4s if some of the talking heads are right about recession in 2024. That's not unreasonable to think that we could see that territory that quickly. But it really depends on economic data, chiefly inflation, getting to the 2% target.
And quick.
Now, what are your thoughts after watching that? Do you believe there's an opportunity for 4% mortgage rates in 2024, or is that just absolutely crazy? Actually, I want to ask you, where do you think mortgage rates are going to end up in 2024? Do me a favor and let me know in the comments below. So my forecast for 2024 is definitely an improvement in mortgage rates. I see mortgage rates going quite a bit lower than where they are at the moment. We're currently sitting around 6.5%. I do think there's an opportunity for mortgage rates in the mid 5% range at some point in 2024. Now, if you're a buyer out there, should you wait for mortgage rates to get down to those levels to buy a home? And my simple answer is no. For every 1% lower mortgage rate that comes to the market, that adds 5 million potential buyers to the market, which essentially means more competition to the market. Now, not all 5 million people are going to buy a home, but some of those people will, which means more competition. And because you're not likely to see inventory increase in a huge, meaningful way, that means more buyers vying over the same properties. So instead of waiting for mortgage rates to go lower, buy when it's the right time in your life. And maybe you're fortunate enough to see a lower mortgage rate in the future and you can refinance. I recently just bought a home and I got a 7% rate. I was able to refinance to a 6.5% rate, a 0.5% difference within a month of actually closing on that home with no cost. And that's because I took my own advice. I bought when it was the right time in my life, and I had an idea that mortgage rates were moving lower in the future, and I took advantage of them when the opportunity presented itself. Now, it came a little bit faster than I thought it would, but the reality is, had I waited, maybe I wouldn't have had that opportunity that I had when mortgage rates were a little bit higher. So just make sure you're taking that into account when you're making decisions out there. And also, take forecasts like this with a grain of salt. Like I said, I've been wrong in the past when mortgage rates were moving higher, didn't think they could move as high as quickly as they did, and I was completely wrong. So whoever you're paying attention to out there, just make sure they're basing it on the right information and they're not out there trying to spread fear and trying to get you to do something just so that they can make money off of it. You know, my channel is all about education, trying to guide you through that process. So with that, if you found any value, do me a favor and hit that thumbs up. But if you want to know what other factors are currently affecting mortgage rates and what's likely to happen, do me a favor and check out this video here.